Okay. So trading is all about repetition of past historical price action on our chart. So this is why we have to always put into consideration every action which occurs on our trading chart, because they will always repeat. They will always come, repeating themselves again and on and often. It's a repetition of past historical price action. So I gave this signal in my VIP members community, and I state, I want to short this currency pairs. Actually, some traders were asking, why do I want to short this currency pairs? Actually, technically, I can figure out, bearish interest, on this currency pairs. And then before I, gonna give analysis what actually occurred right here, we can navigate back to past historical price actions on the chart right here, right from the March of 2020. And then I got a highs right here. We got a choppy market, and then a range market at this medium right here, whereby market transformed in a range market that is in a rectangular chart pattern. And then in a rectangular chart pattern and a bullish upward rally, it has high technical implication of price breaking to an upward movement. That is a continuation of the previous bullish rally. And then which did occur on this currency pair. So I'm going to wipe all this out and then extend my chart to a wide screen, so you can figure out all the price action right here in a bigger image. So on the chart of the European against the Canadian dollar, I love the setup which formed right here, right from the swing low right here. We had an aggressive bullish upward rally to the high swings right here. There is the key level structure, that is the resistance level structure of the 1.59787. Since then, there had been a lesser demand in these currency pairs. There's a lesser demand in the European against the Canadian dollar. And then the buyers got into a state of exhaustion. In a market where our price keeps on trending up, you don't expect price to keep on going in a straight line. And then again, from the swing low right there, you can see this was a very steepy move. Very steepy price move. Price moved aggressively from the swing low right here in an aggressive rally upward, whereby the bears failed to exercise any interest in this rally right here. And then after price got to this region right here, we got a choppy market. What I always emphasize on whenever you are trading the market, whenever you figure out price keeps on or trend or interest or a sign of consolidation, choppy market, reduction in demand and the supply, whereby market keeps on fluctuating within an equilibrium medium, within an equilibrium phase, that it's a signal, such previous trend is gradually getting into a state of what? Coming to an end. So that is why you shouldn't look out for trade opportunity. Trying to trade in a choppy, in a trend within the range, it's going to be very, very difficult for you to make money. Okay? It's just like you are trying to sail in a ship without having the direct destination you are heading to, without having a compass to give you the right direction. You just keep on sailing without a specific direction you are heading to. So this how a choppy, a consolidation, or a market within the range looks like. So you try to avoid such a market. You can see traders who actually try to look out for trade opportunity right here. You don't need any prophet to tell you this is actually gonna be a kind of very difficult trade, a kind of market whereby you get your position being stocked up, whereby you are being charged commission swaps from your brokerage firm. At the end of the day, it's going to be very, very difficult for you to make a reasonable money right here. So not until price opened up again. I think I took this trade which occurred right here. I took this trade. I sold out this trade right here to my VIP members community of mine, which bought this currency pairs after I detected price reacted to this key level structure right here. So I'm going to give analysis how I found the trade right here, and then how I got the trades selling position right here. So The key factor I've got to put into consideration right there is I try to go along after price, this medium right here. Price actually went through what a consolidation phase. And then there's something I want you guys to pay close attention to right here. You can see our price keeps on retesting the key level structure right here. The next coming right here failed. The next coming right here failed. You know, there is always whenever a movement of price have a high tendency to switch the direction of a trend. One of the signals, one of the signs you gotta figure out on your chart is we always give you as more information for you to signal to have an idea what is going to be happening in the next move. In a market whereby it's very, very difficult for you to have an idea what is actually going to happen next, then in such market, the best thing you need to do is just stay out of the market. You don't have to trade all the currency pairs or all the markets you have on your chart. If you can figure out a nice, well-designed, opened market structure on your chart, it means there isn't trade for that day. Not all the time you got to trade. In fact, executing a lot of trade every day means you are exposing your trading portfolio to a lot of risk. This is the wrong mentality most beginners in the market have. They believe when they execute more and more trading position in the market, they tend to get a lot of trading profitable opportunity. No, it doesn't work that way. In fact, just a single trade in a week can make your whole week profitable. Okay, so I gotta put on my AC right there. It's getting warm right there. Okay, good. So I patiently waited for price reaction to this key level structure. So let's zoom in right here. Price went far to close above this key level structure. We can see the rejection we got right here. And then rejection we got right here. Now we got to pay close attention to what actually occurred right there. This is the period at which price retested the key level structure right here. We can see the period right here and the next period right there. It's a short consecutive retest of price. You can see that. So if I should take a measurement from the retest of price from this level right there, if I want to try and take a measurement from this region right here, this daily chart frame, okay, right from this high right here to this high right here. So let's try and take a measurement objective from this level right there. I think I have to add this measuring tools right here, so I can apply this to take a measurement. So we don't even need that. So let's extend the chart right here. So from the bars right here, there's a bar 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. It took 12 days before price could make a retest right here. And right from the retest swings high right here, if I should count right here, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. It took 10 days before price could make a retest again. 12 days right here. Here comes the 12 days. And then here comes what? Or 10 days. And then if I should pay close attention from the swing high right here on this currency pairs to the swing high right here. Right here, you can see it took a longer period of time before price could make a retest right here. If I should analyze all the trends right here, it's gonna take like a 20 plus days. In fact, 30 days plus. So here comes the idea of how price is constantly retesting a key level structure determines how strong a market is. It gives an idea how strong the bulls and the bears are in a such market. So right here, let's pay close attention to what had been happening at the support structure right here. You can see the constant retest of price right here. You can see the chart retest right here. And the price fails to break out of this support structure right here before price went in a higher trend. If we should navigate on a lower time frame right here, you're gonna figure out right here we got a what? A high-low swings right here, at a high-low swings right here, whereby we got a baseline low right here. Here is a baseline right here. A baseline swings. And then we got a what? A higher slope right here of an high low and a high low. And then this is where the price action took place, right here, and then this medium right here. So it's time we pay a close attention to this medium right here before we know, maybe, so we can study what actually occurred right here before the price went in a bullish aggressive rally. So at this medium right here, price ensured a nice close of bar into this key level structure of the price of the 1.54294. And the price carved a bearish engulfing bar. And there, I always emphasize on these actual key points in the market, is especially for inexperienced traders, beginners in the market. Most traders believe whenever they figure out a technical price action signal, maybe it means you got to buy or you got to sell. It doesn't work that way. It's trading. No, it's so easy this way. Everybody would have quit their job and then take trading as a full-time profession. But it doesn't work that way. Whenever a technical price action signal formed on your chart, it doesn't mean you got to buy, you got to sell. No. It means, hey, traders, you got to pay close attention to this price actions, to what is occurring right here. And this whereby your knowledge of bars reading, your knowledge of how to read bars come into play. If you don't know how to read bars, what each bar on your trading chart signifies, what it means, it's going to be very, very difficult for you to know maybe a technical signal which formed on your chart. Maybe it's the right one, maybe it's a fake one, maybe it's going to be a trap for you. Okay? So how let's see a situation whereby some trader always say, wow, or the candlestick, Japanese candlestick is a trash, it doesn't work, Japanese candlestick is not a trash. I'm a raw price action trader. If you have been following my content right now for months, for years, you're gonna figure out on my chart, I don't have indicators. It doesn't mean I don't trade with indicators. The only indicators I can figure out on my chart is the EMA, exponential moving average. That is the 10 and the 20 period. Actually, you can use any period you want. The period simply means the number of time, that is the movement of price period you want to put into consideration. So if you are using the 10 and the 20 EMA, it simply means you are putting into consideration the period of 10 and 20 on the time frame you are trading. So if you are trading based on the daily chart frame and then with the EMA of the 10 and 20, it means you are putting into consideration, you are studying movement of price within 10 days against the 20 days. So if you are trading from the weekly chart frame with the EMA 10 and 20, it simply means you are putting into consideration the 10 weeks against the 20 weeks. Likewise, on the 4-hour chart frame, you are putting into consideration 10 consecutive 4 hours against 20 consecutive 4 hours. Okay, so I prefer trading on my chart without no indicator. It makes me understand better and it makes me think more. And when I think more, I tend to make the right decision. When I implement the EMA indicator on my chart, it makes me feel lazy. It makes me it reduces my strength, the way I think. So getting all this indicator of my chart, makes me think more, and then get more accurate result. In fact, I feel more convenient when I trade without indicators. So this is why one of these days I've been, I stopped, using the EMA, but sometimes in order to make my analysis very easy for the inexperienced beginner traders in the market to understand what I'm trying, the information I'm trying to pass on, I try to implement the EMA sometimes so I can show them how I can use this to support confluence factors, to build confluence factors. Don't worry, in one of my class, I'm going to show you, educate you about how you can build confluence factors to guide you to boosting your confidence, before you take a trade. Actually, I use the EMA for three factors, three reasons for dynamic support and resistance to detect the change of a trend. Okay, so and then right here we got a bearish engulfing bar right here. After price carved a bearish engulfing bar right here, it doesn't mean you gotta place a sell stop right here. What you gotta need to do right is move. If you want to get into this trade in a early, very early stage, the next thing you gotta do after price cap the bearish and going back based on the daily chart frame, if you want to get into this trade very early, you gotta wait for the end of close of this bar to carve a bearish and going back. I hope you understand what I mean by the word end of close of bar. Do you?
Yeah. Yeah.
So what is end close of bar?
Why do I have is this when you have to wait for the next bar to start forming, right?
Yeah, good, good. So that is the meaning of end close of bar. So based on the daily chart frame, you got to wait for the end of close of the spiritual coffee bar. And then after this bar is done through its transformation, then if you want to get in early right here, then you got to navigate to the lower time frame, like the 4-hour chart frame and the 1-hour chart frame. So to get into this trade right here to implement the bearish and coffee bar as a technical bearish price action signal before you can go bearish right here. It means you got to navigate on the lower time frame and then look out for what conformity of signals bars with the bearish and going bar, like the bearish pin bar, or maybe a bearish and going bar as well, or a well decisive close of bearish and going bar below the last swing low of this bearish bar right here. So all this information I'm trying to pass on all depends on your level, experience, your skills of relation of reading of bars, each bars which form your chart. So if you want to become a good, better trader, you got to learn about the Japanese candlestick, about what each bar form on your chart. If you want to trade with the American bar chart, you have to learn how to read the American bar chart as well. So trying to neglect the importance, the benefits, the usefulness of the bars, of the price movement on the chart, it's gonna be very, very difficult for you to have a history and then have a history of successful trading to become a better trader. You know, and then focusing much of our attention on indicators in system. I don't, I'm not here to condemn indicator-based system. Of course, I got people who trade with indicators. But if you want to trade with indicators and then we want to have the best results and then have consistent results, you know, you got to understand raw price action. Once you understand the raw price action, then you can combine any arsenal tools into your trading system. When you combine this trading system indicators with your knowledge of price action, then you have already built a well strong concrete foundation. Okay, so right here, I implemented the strategy, the idea, the skills, and knowledge of a raw price action to detect what's actually happening right here. I figured out right here, I went on the lower time frame. I discovered there wasn't any close of bar right here. So let's check on this structure right here based on the lower time frame. So let's try and navigate that here before we I give analysis about this bullish PMR right here. So based on this bar right here, this was the 15th of July of 2020. So let's check what actually occurred on 15th of July 2020. Okay, so I can simply just have a line right here. So I can a vertical line right here, place. Okay, let's check right here. Okay, I can have a vertical line right here. Okay, no, get this stuff. So let's navigate on the forward chart frame so and trace this vertical line, how it reacted to price actions on the chart, right? Okay, let's navigate right here. I think this is the median, right? Okay, okay, good. You can see the bearish engulfing bar which formed on the 4 hours, on the daily chart frame, I mean. We are trying to track the record based on the 4 hour chart frame, right? And then what can you figure out right here? On the 4 hour chart frame, this is the formation of the bearish engulfing bar. And then You know, trading, it's all about experience. And the more you trade, the more you study, you gain more experience. So right here, if I want to take a selling position based on what I can figure out based on the daily chart frame, because I can figure out a bearish engulfing bar on the daily chart frame, and then this is what I can figure out on the daily chart frame, right? And then I navigate to the lower time frame, which is the 4-hour chart frame, and then I can figure out a peanut of bar right here. What I can figure out right here is there isn't much supply prayer right here. The prayer of selling right here dried up. What I need to figure out right here in order to confuse me, to give a more conviction, to give a conviction of a selling position right here, is I want to figure out a strong rejection of price from the key level structure right here. I want this support structure to act as a new resistance structure. I want a more conviction of the market. I want a conviction the players are willing to stepping in right here, and I'm really interested to put price more downward right here. So what actually occurred right here, there isn't any strong indication right here of this key level structure turning into a resistance structure, which means we can gradually call right here as a what? As a first bearish move. First bearish move. Okay?
Yeah,
Right
yeah,
here, price went in and closed again. For the fact the bullish bar right here closed back above this support structure right here, it means this is a my force out price, a first move, right here. So this bar right here already turn this bearish bar meaningless, useful, it's no more useful, useless. So right here, the bullish bar right here, if you are a sound trader who have a well better understanding, defined strong foundation in reading bars, bar by bar, you would have figured out right there, this is not the right time to sell. Instead, this is a trap, a bearish trap. It's a bearish trap. So figure out those who want to sell right here actually what got trapped. And then here comes the idea, the sayings, no, do not take the first breakout. We can tag this bar right here as the first breakout. First, FIRST. This was the first breakout right there. You don't take the first breakout in a trend. You look out for confirm. You have to confirm, verify, and verify. It's very, very, very important before you execute the position, because right from the time you open this position in your chart, you already are risking your resources. Trading is not about risk. It's about 50-50 chance. It's either you make a profit or you make a losing position. So in the business whereby the risk and the loss, it's always right here all the time. You got to be very, very careful of what you are doing. You have to make a well-defined, analysis. You don't just have to jump into a trade because you can figure out a bearish engulfing bar, a bullish engulfing bar, a bullish morning star. No, it doesn't work that way. Like I stated earlier, if trading is all out, it's very, very easy the way. People say it, everybody would have what? Quit their job and start trading. So right here, I wouldn't want to sell right here. Okay, so I'm gonna move more right here on the 4-hour chart frame right there. Now price made another retest, and this was the second retest right here. Now these are low swings. We got a low swings right here, so I'm gonna tag this structure right here. So okay, I'm gonna have this little bit right here. So I got a low swings right here from this bullish and from this bar right here. So here comes the action of price action analysis knowledge. Here was a swings rejection, and then here was a swings rejection. And then here comes again, price is trying to break through this key level structure. So there's something important I want to show you right here. So let's say, for example, price didn't get to this structure right here. Okay, price only stopped right here. And then this bearish bar moved again into, okay, I'm gonna wipe this out so you can see properly what I'm trying to, information I'm trying to pass on. So let's say, for example, price didn't get to this structure right here. Okay, price actually stopped at this medium right here. No, I'm gonna use more thing. Okay, price stop at this medium right there. Okay, and then we had a second move downward, and then price ensure a bearish close right there. This is the right time I would have wished to sell right here. For the fact price didn't get to this level right here at the first retest, and the price made another second retest. So for the fact price is making a second retest and then ensuring a bearish close out of bar right, out of the key level structure right there, then it's a signal the boosts right here are so weak that they retreated right here. And then the bear steps in to continue what? The previous bearish trend. Okay, but for the fact price got to this level right here, the first breaking out, and the price is making another breakout right there. So this level right there is an invisible force. At this swings left right here comes an invisible force. And we can tag this invisible force right here as a high-low swings. So there is an invisible force which held price in a bullish rally right there. Likewise, the invisible force right there, which price went through a short consolidation phase before price broke out right here. So if you should relate what is actually happening right here based on wave movement, wave count analysis, you're gonna figure out right here, we got a low structure swings right here and low structure swings right here. We can tag the structure right here as a high low and the right here as a high low. So price is coming for the second time to retest this high low right here. Not until price can make a retest successfully of this high low before we can actually anticipate for a more bearish downward trend. So what you should have done if you are in this market right here is to wait for price to ensure a more bearish close below this key level structure right here. And then price did what? Price carved a strong bullish trend going back, which means that is a trader's beliefs. Trader's psychological analysis right there is gradually changing. It means the bears want to pull price downward right here. Likewise right here. Now the bulls are engulfing back the action of the bears. So now let's navigate this, how I analyze time frame and then relate it to other time frame before I made the final decision on my trading entry or selling entry. So if you implement this into your trading strategy, into your trading rules, activities, you're gonna improve your trading history, record. So I'm gonna wipe this out right here and then navigate back on the daily chart frame. So the sentiment right here, the selling sentiment right here is changing. The sentiment right here is changing. And then if you should try and implement a trend line right there from the swing right there to cash right here, you're gonna see right here, price is not yet done breaking through the dynamic trend line. And this is one of the reasons why I don't like to trade with indicators. For me to process information on my chart, indicators sometimes act as how can I put this? It's sometimes leads to confusion, and then sometimes you got too much of overload of information. It's confused. So I feel convenient analyzing, going through each bar by bar on my chart. I feel more convenient. So I need to analyze my chart and then process my data so fast. So I don't need any indicator to cause distraction. Okay, so this is why I prefer to use raw price action, support and resistance, reading of bar by bar, and then using trend line. The best traders in the world, that is Edward and Maggie, they focus majorly on trend lines. They don't use indicators. I'm not saying, or I'm not preaching, or I'm not disputing, or I'm not condemning indicator-based system. But this is what works best for me. And I would rather teach what works best for me instead of teaching what I don't believe.
So, so you don't use other indicators, just trend lines, no moving average, nothing.
It's my chart. You can see right here. Do you see any indicator right there?
Just the trend line.
Yeah. So I don't use them. I feel comfortable trading without them. I don't need the help of indicators. Using indicator makes me feel lazy. And sometimes when I figure out a nice setup on my chart, indicators sometimes confuse me, distract me. And sometimes before I could process my information, illustration adds more complicate the system. So when I trade without them, I feel more confident. I have more confidence. I have more better understanding. Then I'm more faster to execute my trading decision. So this is why I don't trade with them. I feel more confident on trading with them. In fact, I experience more profits on my record when I don't trade with indicators in the system. Actually, this took me years. Like I stated earlier, no, you can't become a good beta trader overnight. It's gonna take you years. It depends on your potentials, on your personal ability. Trading is a course. And then I sometimes when I move around on the internet, on the social media pages, I figure out, when people say trading is a scam, trading is gambling, trading is this, is that. In this business, you have the right to control your loss, you have the right to control your profit. But in gambling, you just have to, you are in expectation of maybe you have a winning result or a losing position or result, but you can't control your loss. Likewise, you can't control maybe if you are going right or wrong. You just have to wait for the end result and know maybe if you are right or wrong. But right here, if the market is going against you right, even before the market hits your stop loss, you can get out of the trade. And you have the right to decide how much are you willing to risk. So when you trade without having the right understanding, without having a healthy money management system, without knowing the proper zone to implement your stop loss, without knowing what you need in the market, without knowing the exact point you have to get out, then you are being engulfed by the spirit of greediness. Ignorance, you don't know what you are doing. Then it appears as a gambling system. This is a business, it has a rule. You got to obey the rules. You got to treat it as a business. You got to play along with the rules. There isn't any emotional feelings right here. The market doesn't know you. It's not your friend. Neither is it your enemy. It doesn't know who you are. It doesn't care who you are. It doesn't care how much you have. Obey the rules, play along with the rule. And then if the market judge you are wrong, obey, believe you are wrong, learn from your mistake and move on. It's not about making profits, which makes you a profitable trader. It's about how consistently can you execute profitable trade. That's what makes you a profitable trader. Every trader make losses as well. I make loss as well. But what makes me a successful trader, profitable trader, is at the end of all my trading historical activity, I still come out with a net profit. So that is what makes you a profitable trader. Okay. And then there's a lot of testimony in my VIP members community, traders who joined. They have having a record of monthly profitable on their trading portfolio. I thought, you join my program for a month before you opt in for a lifetime. If my service isn't, or if you haven't seen an improvement, you wouldn't have opt in. After the first month, you wouldn't have opt in for 3 months and then make a decision to opt in for a lifetime. It's because you have figured out, a positive and remarkable improvement. So that is the reason. So obey the rules and then make things very easy for you to understand. When you try to implement all these indicators based that you try to make things, to try to complicate things. So you have the decision, to choose what you want in life. No one can decide for you. But anything just you want to choose, make sure it's something that's going to be easy for you. Once you make things very difficult for you to understand, it's going to be very difficult for you as well to understand. When you make things very easy for you to understand, it's going to be very easy for you. So that is my own ideology. I try to make things very simple. Very, very simple. Trading is not as difficult as people paint it to be. It depends about the mentality, about the orientation you have, about the education, about the, most people who tend to trade don't have the right education. And most people tend to learn from fake mentors. So, and there are actually, this our business is. You have to learn from your mistakes, learn from your mistake. From your mistakes, you gather experiences. So right here, let's get back to the analysis right here based on this no chart right there. So I'm going to navigate back on the daily chart frame on this currency pairs. So on the, let's check on the daily chart frame right here. So after we got the movement based on the 4-hour chart frame right here, I got a bullish pin right here. So let's decode the information of the parts I got right here. If you want to construct English words, you must add each letter to another. For example, you want to construct a dog, you got to add what? D plus O plus G. Okay, good. So if you want to make a sentence, then you have to connect what? Each words plus words, right? Dice, maybe my dog is what? Brown. This is a sentence in the English language. This is a word, this is a word, this is a word. Together makes a sentence. Same goes to trading in the financial market. Each bar you figure out right there all has a meaning. They'll all represent a meaning. They don't just form your chart just to fill in the gap or to fill in the space or for decorative or meaning or to make the chart looks nice, pretty, good. No, it doesn't. No. They all has a meaning, information they are trying to pass on to you. So it's now left for you to understand. Failure for you to understand what each bar is trying to tell you, right? Then that is when you think trading is all about scam. Once you understand the information right here, you're gonna see it's not a difficult way people say it. I'm not telling you you won't make loss. In fact, loss is what makes this field very loving sweet. It's what makes this interesting. In any business where someone tells you there isn't any loss, it's a run. You got to run. Every business has its own losing loss aspect. You just have to know how to balance your loss and profit. So at the end of everything, you come out in profit. There are business establishments to big organizations, which at the end of the year, after the analysis, every record, they're going to come out in losing trade. They're going to come out in loss. It doesn't mean the next coming year, such business would make profit. Okay? The biggest, greatest in the investment or investors in the world, Warren Buffett, great guys make loss as well. But at the end of everything, they still come out in profits. So loss is part of the business. So that is why before you execute a position, you must have your stop loss in place, should in case things goes not in favor of your anticipation. So right here, I got a bearish bar which failed and the price carved up again. And then we got a bullish pin bar right here. In one of my class, I'm going to discuss about protruding bullish pin bar and the bullish pin bar which fits in properly into a key level structure. It's one of our class. I'm going to give analysis about how you can actually look out for a fake and a real bullish pin bar. So I'm going to just give a quick idea right here so you can have an idea what I'm trying to pass on right here. So there are 3 types of ways your bullish pin bar can form on your chart. We got a first bullish pin bar which can form like this. And then we got another bullish pin bar we can form like this. Whereby the midpoint would be at the middle of your key level structure. And then don't forget, in one of my classes I discussed about treating your key level structures as a point of area, as an area, not not as a concrete level whereby you expect price must always come in direction of what you expect or move in direction of the way you expect it to be. It should be treated as an area you got to pay close attention to. And then right here, we got another bullish pin bar which can actually form like this. In fact, you can get another bullish pin bar which can form like this. So I got a question for you watching this webinar class. So my first question, I'm gonna ask you, okay, I'm gonna tag this question right, or this bar right there. I'm gonna tag this bar right here. Let's tag this right there as a bar A. This is a bar A. And I tag this right here as a bar B. I tag this right there as a bar C. And I tag this right there as a D. So my question goes right here is, which of these bullish pin bar right there is the most reliable, strongest of all? Which? Is it the A? Is it the B? Is it so? Take note, this is support level. Okay, then I'm gonna get this now. Hang on. Here is the support. Okay, this is support. Okay, so which of this bullish pin bar right there is the most reliable one? You should consider worthy to be traded on your chart.
I think C and D, right? Because
what?
Because you see from C that it respects the support level, but
Okay.
you see from D that it continues the trend to bullish.
Okay, you mean this one is right to kind of be traded, right? Okay, you support
Right.
this, right? And what about D?
D tells you that the trade is it continues to be bullish.
Okay.
The trend is
In respect to the key level structure right here, if price should occur right here, and then I want to treat all this bar right here as a potential pin bar on my chart. Due to my years of experience in the market, I would love to neglect this bar right here and then this bar right here. Neglecting this bar right here doesn't mean it doesn't has a high possibility of a continuation of a bullish trend. But due to my years of experience in this field, in this business, in trading, the probability of this bullish trend pin bar leading to a bullish rally, it's low. The chances is very, very, very low. And I'm going to give a more explanation right here. I would prefer to trade A and B. And the most strongest right here is this. So why is A the most strongest pin bar? And why would I want to neglect C and D? So in the next class, I would go more deeper, deep into this, but just to give, a quick, understanding. So I don't want you to miss the next class, okay? So I don't want you to miss the next class. So right here, we got a bearish downward trend. Price got to the support level right here. The bears went down, down, deep, deeper, deep. And the bull steps in aggressively, pulling price upward and then ensuring a close back above the support structure right here. What makes a pin bar a reliable pin bar? What makes a pin bar reliable pin bar? The rule states the tail of a pin bar must be at least twice the size of its head. This is the head of the pin bar's right here. This is the tail. If I should take a measurement objective for measurement, take measurement of this pin bar right here. Let's take, for example, all this tail right here are 2x, or let's make it as the way we can figure out on our chart. This is 3. The head is 1 pip, or let's make the head is 10 pips, the tail is 30 pips. Likewise, all these 10 pips, 10 pips, and then 10 pips, and then 30 pips, 30 pips, 30 pips. And the rule says the tail must be at least, the rule states the tail must be what? 2 times the size of the head. That means if the head is 10 pips, 20 pips, 50 pips, the tail must be at least multiple 2 of the hair size of the head. So right here, the pin bar obeys the rule, and they even went further times 3. Okay, good. So now we got to put into relation our price relate, our price react to the key level support right here. Right here, more than 2/3. In fact, we got no a close of bar more than 2/3 of this tail right there. In fact, more than 20 pips closing above this key level structure right here. I can tag this movement from the edge, from the tail of the edge, right? I got a call right here. Let's get this off. Sorry, I got a call. I got to put my device right on my silence mode. Okay. So the tail right here is 30 pips, and then it closes back into this above this support right here, more than 25 pips. Or the more tail, the tail close above from this low right here. And the right here, the midpoint of the tail of this head is at the middle, is the flow aligns to the support structure level right here. Okay? And the right here, the tail is just above the support right here. And the right here, the tail is much more far away from the support. Right here, there is more conviction that the bears try to pull price downward, but the bulls aggressively pull price upward, thereby reacting to this key level structure in a more clearer mode. And the right here, the bears went in more deep at the mid with the half of the tail of this bullish pin bar, and then the bulls step in and pull price up. But right here, there isn't any relation or any reaction with the support level structure right here. Price just carved a bullish pin bar. And then remember the rules. For a signal bar to be treated as a reliable signal bar, maybe it's a bullish pin bar, a morning, no, whatever signal bar it must react at a key level structure. A pin bar, a signal bar, which doesn't have a relation with a key level structure, maybe a support or a resistance level, the chances of it transforming into a potential bar, signal bar, has a reduction of one factor. And that is a factor, it's not in relation with what? With a key level structure. Likewise, right here, this pin bar right here is not in reaction with a key level structure. So if I should count the factors right here, the factor right here, we got a one factor right here in reaction with a key level structure. We got a one factor right here. Right here, there isn't any factor. Right here, there isn't any factor. So there is what? A reduction of a factor supporting a bullish bias right here. For the fact is not in reaction with a key level structure. And then a key level structure is a point of interest for either the buyers or the sellers. So which means right here, the pin bar which formed right here is not in reaction with a point of interest, which means the chances of this pin bar transforming into a bullish trend right here has been reduced by a factor of 1. But right here, the bullish pin bar right here reacted at a point of interest. And the point of interest does suggest that the bulls are more interested in the price action right here more than the bears. And then they won the battle right here. And the right here, they won the battle. And the right here, this is the battlefield. The support level right here is the battlefield. There was just a war zone right here, but not on the battlefield right here. In fact, there isn't a war right here because it's a battlefield. So this is just a mere movement of price. So that is why you always have to treat your signals bars very important whenever it transform at the key level structure. And that is one of the reasons why most signal bars in your trading chart fail, because they do not form at the right place on your chart. So you got to put this into consideration whenever you want to trade a signal bar. It has to form at a key level structure, at a points of interest. Okay. So next time when you figure out a signal bar, you got to treat it to a key level structure. You got to treat it to demand and supply zone. Okay, so I'm going to wipe this out. So on this chart right here, this pin bar right here can be regarded as the B example bullish pin bar. So you know how to execute a bullish pin bar strategy. There are ways whereby you can apply it. You can implement the 50% Fibonacci retracement level, but in a very, very aggressive, strong rally, you may end up losing trade entry. And then you can implement your trade entry right from the next opening of bar or some pips above what? The pin bar. So I executed a trade above a pip right here, and then we got in a profit right here with our stop loss right here. With a what? I think 3 risk reward ratio was being achieved right there. So now we got another what? Action of price again right here. We can see right from this medium right here, after price went from the swings level. Okay, I gotta put, sorry, I got a reminder notification right here. Even the class is up, but I'm gonna just quickly round up this no class now. Okay. So right here, I got, okay, I'm gonna just get this. Right here, we got a bullish rally. Okay, let's make use of a black pen. So it's gonna be very easy for you to see right here on your chart. Right here, we got a bullish rally, then a bearish wave right here. We got a support structure right here. And then before price go to this support structure right here, we had a pattern inside right here, which can be categorized as a rising channel, which has a bearish technical implication. And then let's try and zoom in right here. So we got to pay close attention to what support, to demand and supply right here. We can see there was a demand right here, weak supply right here, demand right here, an increase in supply right here. And then what occurred next? There was what? A decrease in demand right here. And then supply increase. In the market, whenever the buyers are willing to buy more and more, the sellers have to step aside. And when the buyers are done buying, the sellers have to come in and sell. So it's tends to get to a state whereby both the force of the buyers and the sellers comes into a state of equilibrium. And then it gets to a point whereby when the other counterparts execute more force than the other counterpart with much more force tends to dominate the market. So right here, we got a bearish trend right here. Here is the bullish trend. We can see a choppy market trend right here upward, and we can see a well-trendy bearish trend right here. At this medium right here, we can have a better idea that the bears right here are much more eager to put price downward than what the bulls are trying to do right here. So if I should take the slope measurement right here of this trend right here, right from the high right here downward, you can see I got a 39-degree of this downward movement right here, which means the bears are so strong right here. Above 45-degree or minus 45-degree represent a steepy slope, which means price is moving much more aggressive, more faster. So do not worry. In one of our class, I'm gonna teach you how to implement the slope of a trend, how to analyze, put into consideration slope of a trend to determine the next movement of a trend in the market. So, and then if I should take a measurement objective of this, so let's get this off right here on our chart. So I can take the slope of the trend right here as well. If I should take the slope of the trend right here with my right here, you can see right here, I got a 19-degree of slope right here, which means the bullish force right here, the demand structure, the demand, the rate of demand, the demand right here, prayer right here is lower than what we got from the high right here, downward right here. You can see right here, 40 degree, was the degree of slope right here. So it means the bears are so much strong, eager right here to put price more downward right here, whereby the bulls are actually getting to a state of what? Exhaustion. So let's get all this off on our chart so we can have a clean chart to work with. So right here, we got price moved up. The bear steps in, ensure a well-decisive close-up bar. We got a rejection structure right here, which we can tag as a minor level. And then there was a retest of the minor level right here with a gravestone bar. And this is why I emphasize when I said every bar on your chart has a meaning. They don't just form for the sake to beautify your chart or to fill in the gap. They all has a meaning. So what occurred right here has a meaning. This structure right here has a meaning. This structure right here has a meaning. This structure right here tells me there isn't much happening in the market. And this right here tells me there is more demand right here than right here. And right here tells me there is much demand right at this zone right here than we did have right here. And what occurred right here tells me there is much more selling prayer coming to the market. And then here is a key level structure which was being retested and then being rejected. Now I went short right here. And then here is the daily chart frame. Don't be surprised if the daily chart right here definitely ensured a close of bar below this key level support right here, which was a support for this bullish pin bar right there. The daily bar should ensure the daily close of bar below this key level structure of the 1.54294, which was a support for the bullish pin bar right here, and the high swings right here. Then don't be surprised. The bears have high probability and high potential to pull price more bearish downward. So this is how I related bars to each bar on my chart to detect trading opportunity instead of focusing my attention on indicator. When you focus your attention to indicators, for you to learn fast, for you to know what is happening, it's gonna widen and then increase the how can I put it, the normal duration of time you should actually go through in order to gain more experience to become a better trader you have always wanted to be. But I'm not condemning indicator. But to summarize everything in this class today is, before you focus your attention on trading with indicators, the best thing you need to know is learn to relate to read bars with bars before you venture into indicator. To summarize it again, if you want to become a pilot, you are not first taught, you are not first introduced to the autopilot. First thing you are being taught is you are introduced on how to manually control the aircraft. Then after you've mastered how to manually control the aircraft, then the last thing you're going to be introduced to is how to use the autopilot. So try to manually understand how price move before you move into auto, and that is the indicator-based system. So thank you so much. Have any question for me?
No, I don't have a question.
So do you understand everything, or the question, or the in the class today? Hope you understand everything. Do you?
Yeah, I do understand most of the things.
Okay. So any question?
No.
And then if you guys are going to watch this video, maybe I'm going to share this video so that other traders can as well benefit from this class. So Josh, can I? Because it's your personal class. It's a VIP members community, personal, special, premium or class whereby I communicate directly one-on-one with the VIP members, community of mine, whereby they order for a premium class. Only I, as a mentor, and the student. So I got to take permission. So the student is giving you the right to access this content online. So kudos to George.
Yes.
Okay. Thank you, George. Thank you. And then do have a wonderful day. Is it evening right there or noon?
It's afternoon.
Okay, no, it's evening right, and then in the next hours I'll be going to bed. So thank you, George, and then do have a wonderful day, and then don't miss the next class. Okay?
I'm not gonna miss it.
Okay, bye. Okay, welcome.